My name is James Lee. I'm a partner at a private equity M&A group at Proskauer. And I'm here joined by Matt Hansen. He's the co-founder and managing partner of Financial Services Capital. He's focused on the financial services sector throughout his 20-year plus career, starting from Madison Dearborn and then leading on to leadership roles for Services Capital Management with respect to their UK and European platforms. Matt, we thank you for joining us today. We appreciate taking the time to speak with us today to share your experience and thoughts regarding your firm and the private equity industry as a whole. Matt, I know you'll be going to discussing value investing, so of course when we hear that term, our brains immediately turn to Warren Buffett. More recently, his famous quote from his 2021 annual meeting, which I'll paraphrase here for everyone: Charlie and I are not stock pickers, we're business pickers. So we really appreciate your interpretation of value investing.
Yeah, one thing I like to do is, because that term gets bandied about, quite a bit, is just to level set, the audience on, what the sort of history and philosophy of value investing is. In the valley where trees go to the sky, it's sort of a different way of investing. And so to get on the same page, rule number one is, first and foremost, don't lose money. Rule number two is, don't forget rule number one. And Graham and Dodd and I went to Columbia Business School and took all the value investing classes. So this is basically it, right? Your preservation of capital, return on capital with the robust margin of safety, which is Seth Klarman's, evolution and heuristic. We don't make bets on technology. We don't make bets on consumer adoption or anyone changing their behavior, doing anything new. I think that the hardest part of sort of living value investing is the patience, right? And the environments that I'm the most uncomfortable in, are the environments that we are just exiting, right? Where everything, does well and everyone seems smart, and those times for me are kind of terrifying, right? Because you have a bunch of people that are, caught up in something, the patience to not get caught up as, your friends and colleagues are getting way wealthier than you are, by the way, and sort of stick to this philosophy. The rationale for it is, it's what I know and it's what I was taught, and Cerberus is a very deep value place, and I was there for almost 15 years, and I really kind of beat it into you. Madison Dearborn's also a value investing place, and a great place to learn it. But what you find is that the longest serving, most sustainable private equity firms are all centered around the value investing proposition, whether it's Dick Fairmont, who was here yesterday, or his friend John Canning from Madison Dearborn, some of the founders of the industry, right? They were probably the most innovative guys in private investing, right? They created the asset class, they created the GPLP structure. I mean, you talk about innovations in finance, the stuff that they were doing in the 1970s, as the forerunner to the conferences that are filled, talking about private equity. Like, those guys were as innovative as, anyone in Silicon Valley, for sure.
So maybe we go into the next slide here.
Yeah. So the way you go about value investing, again, it's a very different way of thinking about capital, right? Always have to make money on the buy, and that rule number one is the reason why in like these extended bull markets, I find myself very uncomfortable. And in these periods of intense dislocation, like the one we're in now, right? Your ability to make money on the buy is all over the place. Like, this is the period for the value investors. And the ability to put out vintages where you're buying at a deep discount to intrinsic value in a value investing style with a long-term perspective, and the ability to improve the operations as an owner, but with technology as part of your DNA, right? Part of our mojo is we take these 30, 40-year-old rickety systems, largely programmed in COBOL, and we just bring them up to some place that's relatively current, like not bleeding edge, but maybe 10 years behind. And that's like a massive leap forward in our sector in Europe. So making money on the buy, then creating value through operational improvement, right? And our firm is centered around that. All of our partners are operators. So we deliver on that. And I did steal a page from Steve Feinberg's book at Cerberus and his COAC, and that operational focus. I would almost call Cerberus, 2.0, right? 1.0 is the creation of the asset class, done by, the guys at Continental Illinois and First Chicago and, Dick Cranwick and the others. That was big. 1.0 is the biggest event, in the history of the industry. 2.0 is, okay, doing the deal is not magic anymore. That's been commoditized. You have to make money for your LPs by improving the businesses in which you invest, right? That was private equity 2.0, right? And now there's a natural next step, right? And that natural next step, private equity 3.0, is you maintain the tenets of value investing. You maintain your pricing discipline. You maintain your patience. You make the money on the buy. You improve the operations, but if you do not understand technology as it applies to your sector, in your industry, in 2022, I don't know, it's inconceivable to me that you could even think about setting up a private equity firm in this day and age without a deep, deep, deep understanding of technology at use in the sector in which you invest, and your ability to modernize and reduce the risk of the data traps that exist in the financial system and the incumbents. Unlocking that gold mine, right? That reduces risk because you have more insight into what you're investing. It reduces risk because you know every risk and exposure on the balance sheet. You can only do that with the 6-month private equity diligence period, right? So we're all about seeking and destroying risk. And that is all we think about. It happens to create a lot of value, right? But that is a collateral effect of a maniacal focus on risk reduction.
Now, as you see, you see it's a 6-month diligence period. I mean, I think many people in the room know the speed of deals now go a lot quicker than they did, in the past. And how are you able to kind of apply your, 6-month of diligence, process in this, content market?
I say 6 months of diligence, and I use that as sort of a short, heuristic that the diligence that you have to do on financial services firms is more intense than the diligence you have to do on widget manufacturers. So if you're going to quote 3 months for a widget manufacturer, you should quote 6 months for a payment business. Now, that's if you're starting from scratch, right? If you're a generalist and it is one of 100 sectors that you cover,
Fair.
right? To get to a point where you understand what you're buying from scratch as a generalist, 6 months is not enough. And it will never be enough in this sector, right?
Right.
But if you have a team that has been operating in Europe, right, at the C level, so we don't just know the institutions that are selling their subsidiaries, right? We know the guy that was the chief risk officer responsible for that, business and his, wiring. So we know the books inside of the banks and the insurance companies at a level and depth that, from the outside in would be very difficult to duplicate. And with that type of transparency and insight, this sounds super, super, I don't know how to say this in a way that doesn't sound bad, but when you're as deep into a sector as we are, and when you're as deep into a geography as we are, we're starting on the 90-yard line. So that 6-month period for us, we've done the 90% of the work to get to the point where we're focusing on those 2 or 3 things that are the big risks. And that's all we focus on, right? That last 10%.
So you talked about the requires a lot of patience, for these value-based, investing, what does your firm do to somehow, accelerate to accelerate the kind of the value of these companies, and how involved does your firm get involved? Because, you just said a lot of your partners are operators, and, just would love to get your perspective on that.
Yeah, look, that's the downside of our strategy, just to be totally transparent. We get really involved, some management teams don't like that. They tend to be the management teams that, have less experience than their owners. And that's a very uncomfortable situation for those people. And, that's when, you find out whether or not they have a growth mindset. And if they do have a growth mindset, then the incumbent management teams can develop and produce amazing results that they didn't even think that they were capable of. If they don't have a growth mindset, then that's a problem, And so the growth mindset is the real, we price businesses so that we don't lose money.
Mm-hmm.
And the way that you price businesses so you never lose money is you do diligence, you know what the liquidation value is, or intrinsic value or rock bottom value, and you make sure that you're betting with the margin of safety below that. But that's not the plan you execute on. You have 220 years of operating experience. You have a unique ability to revamp their MIS systems, bring them out of the 70s and into the 90s, which doesn't sound that Herculean, but it makes a big difference. The whole game in private equity is having enough depth and enough breadth to be a thought partner and guide, like almost a Sherpa, for your management teams, and none of the guys that Edmund Hillary or whatever get all the credit for climbing Everest. We just want to be the Sherpas. We want to get those guys to the top, and if we never get any credit, that's great. If no one ever knows that the Sherpas exist, perfect. I want to be a Sherpa.
It's great, because you always have a deep focus on creating value for your shareholders. And that's something that you've been continually focused on throughout your career.
Oh, so fiercely. I hold the places that taught me private equity, in very high esteem. The guys at Madison Dearborn, they get all the credit with their peers and the Dick Cranliches of the world for creating this, So just unlimited respect. And then Steve, Cerberus and their operational focus and their assiduous defense of their LP interests and their transparency, those are things to aspire to. Being completely and totally transparent with your LPs at all times, right? Cerberus is famously good at that, and I want to emulate that. And then, fiercely protecting your position and your fiduciary responsibility, like it's your mom's last dollar. And that mentality, as an owner, has served Cerberus's investors well. There's good and bad about every firm, and there's some good elements that I've learned from my previous experience, and some things to avoid, and those are definitely some things to aspire to.
Mm-hmm. Maybe just shifting, we are entering different opinions, depending on the jurisdiction's environment, where interest rates are going up, appetite for risk is, coming down. How is your firm positioned to continue to be active during this time? You mentioned it's probably a better time for you now.
Yeah, it's just one of those things, in life, when you get these dislocated environments, and there's real suffering in the world, with the Ukraine war and the cost of living and the interest rate adjustments, those are all very, very difficult things on a human level. But, it's my job to get the highest risk return for my investors. I can't help but be excited from a business perspective about, the dislocation, the valuations, the massive amounts of opportunity that we see. Our pipeline right now is about $1.5 billion proprietary exclusive transactions. That's already 3 times our fund, which, the environment that we're going into to deploy capital is, I think it might be the best that I've seen in my career.
Wow. That's saying a lot. That's saying a lot. maybe just kind of, I'm just kind of hammer home this private equity 3.0 here, and how do you see in your interpretation of private equity 3.0, how is that going to change access to capital, access to assets and things of that nature? And
Well, look, the big guys, the mega funds, they don't have to prove their right to exist. They exist and they're going to get the allocations that they want from these rooms, as long as they want. We have to prove that we have something that is so different and so better that we're a better alternative to that household name. Trying to convince someone to not buy IBM is quite a task. So if you're not thinking in terms of differentiation, if you're not thinking in terms of evolution, if you're not thinking about where the puck is going as opposed to where the puck has been, you might not build a resilient platform. I don't know what the elements to build a resilient platform are, but I think that focusing on an investment philosophy that's durable, bringing private equity into its next stage of evolution, those are big ideas, and we're trying to prosecute them. And on private equity 1.0, 2.0, 3.0, the invention of the industry, the invention of adding value through operational improvement and promulgation of those, and then I'd say 3.0, is really espoused in my co-founder Miroslav Bublik, who is he's way smarter than me. He's a genius savant when it comes to just about everything, but his training is in technology. And, I think that he is exceptionally good at the technology element of risk reduction, right? And so when we talk about technology, we talk about it in risk reduction. More transparency on what the companies are doing, more transparency on the credit they're extending, more transparency on the scoring, more transparency, more transparency, more transparency. And if you drive that all the way through your portfolio companies and back to your LPs, and you do that with a co-founder that has spent his life developing and improving technologies in a cost-efficient way, then you can have the arrogance to talk about private equity 3.0, right? I'm a nobody. I'm not John Canning. I'm not Dick Kramnik. I'm literally nobody, and I'm trying to do something a little bit new, a little bit different, and attract the attention of people with, this private equity 3.0 concept, which I think is necessary, if you're going to build a private equity firm today.
Most surely and sustainable, and like yours, of course. I think a lot of you people would be interested because, in particular, you've been investing in Europe and the UK for a very long period of time, and a certain amount of specialization in that field, in that space. What are certain factors that managers should be particularly focused on when they're investing into these jurisdictions? I mean, we talk about Spain, we talk about Italy. I mean, we're going from country to country.
I'll tell you what doesn't work, because I've watched this movie, God, I don't know how many times. The 35-year-olds that fly over from New York that go into the, governor of the Bank of Rome and tell them how things are going to be. That's never really worked out that great. Okay. And given the sector that we invest, the regulators and the politicians have to really look at you as a safe pair of hands. You're really involved in their economies. You're really involved with their citizens. So it's incumbent on us to be whiter than white, totally transparent, and the regulators like that. And you earn a reputation with the regulator to be their partner, to be transparent. And that's where you have to start in our industry. Because if you're not a friend of the regulator, you are not gonna be a successful financial services investor. And if you don't understand that that is the foundation of investing in financial services in Europe, and that those regulations and those politicians care about their citizens who vote for them, right? Citizens elect politicians, politicians appoint regulators, regulators instruct financial services firms. That's the chain of command, and you cannot skip it. And your big branded card is not gonna they will certainly listen, but they want to be sitting across the table from someone that speaks their language, that understands their culture, that understands their sensitivity, that understands the things that they can't even tell you about that they're wrestling with on the political front or with some other committee, and all these other things that you pick up over decades and decades of investing in this patchwork quilt of 31 different countries and sovereign nations and regulators, and there's all kinds of seams in Europe, right? Because you have these supranational governance bodies, you have these local governance bodies, you have these local regulators, you have the supranational regulators, you have the ECB, the single supervisory mechanism, the Bank of Spain, the Bank of France, the Bank of the Netherlands, and these are all human beings that have never left their seats by and large. Because in Europe, unlike the United States, time's up, you get a new president and they totally change the entire regulatory apparatus. In Europe, that doesn't happen. Like, these guys stay in their seats for 40 years. So if you build a friendship and a relationship and trust, that will serve you well for the entire life of your firm. And I'll end on that.
Well, thank you, Matt. Really appreciate the time, and I'm really looking forward to see Private Equity 3.0 evolve in front of us for the next 5 years.
I hope we can make it happen.
Thank you, everyone.
Thanks.